Well, howdy there, folks. I'm absolutely in shock right now. We got to speak about one of my stocks just reported earnings. I'm pretty in shock in regards to the situation. Got to talk about some other earnings, some opportunities in the market, a few other important subjects here today. So, action-packed video. Appreciate y'all joining me. Thank you for being subscribed. Thank you for being here, folks. Where I just want to start out today's video is I saw this on the front page of CNBC here. Mortgage rates plunge and demand finally inches back up. And it cracks me up because it seems like everybody wants this real estate market to bottom. And I was just kind of reading through the numbers. Applications to refinance a home increased 2% for the week, and were 7% lower than the same week a year ago, which, by the way, a year ago, was anybody refinancing a year ago? Like, you would have had to be insane to even be refinancing a year ago. Like, the numbers are already dead back then, right? Applications for a mortgage to purchase a home rose 3% for the week, but were 20% lower from the same week a year ago, which, by the way, home sales were already trash like this time last year. So, it cracks me up, some of these headlines sometimes I read, out there, and I'm just like, goodness, like, how desperate are we to bottom out this real estate market, okay? Where I actually want to start out today's video is actually speaking about Warren Buffett, okay, and an approach Warren Buffett has in the market that I think is very important. Everybody understands this, and especially if you're a newer investor in the market, because sometimes people in their first couple of years of investing, if you're super experienced, you understand this point I'm about to make here. If you're not very experienced, you probably don't understand this yet, and it's important I bring this out to everybody. I think it's so important, and I made sure I started out my Twitch live stream talking about this as well, and I was just like, I need to get this across so everybody understands this, okay? And I learned this point from Warren Buffett. Warren Buffett has a view of accumulation of shares, okay? And when you're accumulating shares, basically meaning you're buying a stock, right, over a given time period, first thing you got to understand is you don't go all in at one time. That's a pretty dumb move usually, to just be like, I'm going all in the stock and just buying it. That's one of the biggest mistakes that retail investors make, is they think like, I got to just like put all my money into one stock in one day or something like that. No, okay, that's not the way this game's done. It's not the way Warren Buffett does this game, or any super experienced, successful investor. None of us do that, okay? We don't go, here's it all. We got no more money left. Like, no, that's not the way this works at all, okay? So you don't want to do that. So you're going to accumulate a stock over a 6-month, 12-month, 24-month, 36-month time period, right? Now, when you're accumulating that stock, you want the share price to be as low as possible. And there's a different viewpoint than a lot of people think before they get into the market, or when they're kind of new. They think like, I just want to buy the stock. The goal is to buy for as cheap as you can possibly buy, right? And I'll give it to you an example like this, right? If you had the same stock and you could buy the stock at $40, $30, $20, or $10, like, what would you rather buy it at? $10, obviously. You should want to buy it as cheap as you can possibly buy it. The reason some people don't like to buy a stock that's going down, especially if they're inexperienced in the market, is they feel like it must be a bad stock because the price is going down. That doesn't mean that at all. It could mean that, but it doesn't mean that at all. I've seen a million stocks go down significantly over time. Every company we all respect, all the Magnificent Seven, those stocks have all crashed many times in their histories, 20, 30, 40, 50, 60, 70%, incredible falls. So the thing that's important to understand is you need to get as many shares as you can possibly get over a given time period. You should literally root for your stock to go down in the short term. What do you need it to go up for? To make yourself feel good? To pat yourself in the back? Oh man, I just bought in the stock and it's already making me money. Like, there's no reason. If you're a day trader or something like that and you're trying to trade in and out of stocks and gambling money, well, that's a whole different ballgame, right? You needed the stock to go up immediately after you bought it. But if you're a long-term investor, you should actually root for the stock to go down short-term, right? If it's like going to Starbucks, and imagine at Starbucks, they're like, sir, for that Frappuccino, would you like to pay $5 today, $10, or $20? And you're like, it's the same Frappuccino, right? Same thing, same size, made the same way, but I can either charge you $5, $10, or $20. I think I'll pay $5. Thank you very much, sir. That's the name of the game, folks, okay? So when you're accumulating, want the shares to be as cheap as you can possibly get them, so you get as many shares as possible. And also, there's another component of this. If you're buying a stock that has probably fallen a lot, and the company's a great company, that means they make a lot of cash flow, that company's likely buying their own stock back. So which means not only are you getting to acquire shares for as cheap as possible, but on top of that, the company's buying back shares. And you want them, if they got $1 billion buyback, damn it, you want them to buy as many shares as possible for as cheap as possible. So you, the company, everybody should be hoping that stock can be as low as possible while you add to that stock. And there's a third component that's very important that you got to understand in regards to this, okay? And this can screw you up so freaking bad. If you start buying into a stock and then it goes up immediately, many times us as investors look and we say, we'll wait for it to go back down. I just bought this stock a month ago when it was 10% cheaper. I don't really want to pay an extra 10% premium today, 20%, 30%, 40%, right? A good example of that happened to me is Nvidia stock. I started buying Nvidia stock at the end of 2018, okay? I started my position in the public account in Nvidia, right? And then the stock went up a bunch at the beginning of 2019. And I stopped buying Nvidia stock. Then the stock entered what I call no man's land. No man's land for stock is when you're like not really buying more shares, but you're also not really selling shares, and you're kind of like a little lost. You didn't really get to build the position you wanted to build, and so you're like a little lost. Like, do I really want to continue to hold this stock? And ultimately I end up selling Nvidia after I made a little short term, 10, 20, 30%, whatever it was. Small money. Nvidia ultimately 10x'd, over 10x'd from where I bought it at. Think about that for a moment. Over 10x, right? In a matter of years, not even like that long of a period of time, 5 years or so? If Nvidia, instead of going up right after I started to buy it, if it kept going down, I can tell you what I would have done. I would have kept buying, built Nvidia into a really good sized position, and things would have been beautiful, okay? Another good example of that is Tesla. But Tesla, I got lucky. I got it my way, right? And it's where instead of Nvidia went the opposite way and needed it to go. Nvidia needed to continue to go down. Instead, it went up in almost a straight line. With Tesla, I got the perfect situation. I bought into Tesla shares right here, March 3rd, 2019 in the public account. Paid a split adjusted basis $16.97 for those shares, which I've now made over $30,000 on, right? Then the stock went down. So March 13th, I buy more shares, another 180 shares at 15.10 there. That up $37,000 on there. Then I buy these shares right here, May 17th, 2019, 255 shares at 14.64. Those ones I'm up over $52,000 on there. Then I make a big buy here, 435 shares, $13.12 on a split adjusted basis. That was May 20th, 2019. Those ones I'm up over $90,000 on there. Then I buy these ones, 225 shares, $12.57, $47,000 gain on those ones. 255 shares, $14.88, $52,000 gain. Nvidia could have looked like that. Nvidia could have looked very similar like that, but instead of Nvidia keep going down after I bought, it started going up and up and up. And I ended up kind of getting in no man's land. Next thing you know, I ended up taking my short-term profit instead of a long-term profit, right? I could have been Tesla. Tesla could have went that way. Like maybe if Tesla started spiking huge right after I bought, maybe I never build out a decent-sized Tesla position. Maybe I'm not sitting on all those gains and been able to take all those crazy profits over the last couple of years, right? Meta, if we look at Meta, I'm up $359,000 on the stock in the public account, and this is a good example of a stock that I bought over years, right? I acquired for the first time in the public account here, July 27, 2018. I bought 53 shares at $174.42 there, right? And I obviously bought Meta on and off for years, right? And then I got a gift given to me last year. The gift was Meta stock crashed, and I bought these shares, 193 shares right there. I'm up $37,000 on those. $22,000 gain on that one. This one's $147,000. I'm up on this 650 shares I bought there at $93.12 on Halloween. I bought those shares on Halloween. Woo! It was a scary time. Not for me, for everybody else, I guess. October 3rd, look at this. 62 shares somebody sold me for $88.94, sitting on $14,000 in gains on just 62 shares I acquired there, right? So Meta's a good example of just being able to buy a premium company over a period of time there, right? And so the most important thing you got to understand, if you are buying into great companies that have bright futures, meaning their margins can increase, their revenues can increase, their net income can increase, and you're buying, the thing you need to root for is that stock to go down short term. Buy as many shares as possible, root against that stock, hope you go lower. Listen, what do you have to lose? Like what? You're afraid the account's going to say negative 30% on that stock, negative 15%? That would only show me that somebody's very, that's the best way I could put it, very unconfident in themselves, maybe very insecure in themselves, to have to, reminds me of like going to the gym, right? And you go to the gym and, instead of doing the workouts you need to do the way you need to do it, you try to put as much weight as possible, even if your form's horrible or whatever, just to try to show like the people in the gym, like, I can lift this much weight. I don't care if my form's horrible and I'm not really doing what I should be doing in this workout. I just want to look as powerful as possible. But here's the thing. When you're investing, no one even sees your portfolio. You're the only one that sees your portfolio, unless you're a public figure like me, right? You're the only one that sees it. So who cares? Who cares? Root for your stocks to go down short term, okay? You shouldn't need that big of an ego boost. If you need that big of an ego boost, trust me, there's other ways to boost your ego out there than needing your stocks to go up short term. Like, come on, man, okay? Very, very important in regards to that. Now, 10-year Treasury has started to fall here recently. The headline says investors consider state of U.S. economy, right? U.S. Treasury yields fell Tuesday as investors assess the outlook for the economy and monetary policies as they await economic data and comments from Federal Reserve officials. The yield on the 10-year Treasury was last trading 9 basis points lower at 4.573%, and the 2-year was also slipping, okay? There's some confidence growing in two spaces right now. One is the Fed is done. There's a lot of people getting very confident the Fed's done now at this point in time. The second one is rates have peaked. And so that's starting to become the consensus, I would say, out there on Wall Street. And so if that's really the consensus, then maybe we are at a place where at least yields can start to fall. Now, something that is likely going to see, because this affects so many different things in so many different ways, okay? And by the way, just because yields are falling doesn't always mean good. That could mean recession's coming in 2024. So that is something to keep in mind. It's not always like necessarily a promising thing. But there's something that's going to go up substantially. If yields have truly peaked, if the Fed is truly done, and yields are going to continue to come down, then there is an instrument that is likely going to go up significantly over the next 6 to 12 months if we're in an environment where yields keep going lower and lower and lower here, okay? And that instrument, I'm going to show you right here, is this. This is the instrument. It is TLT, okay? TLT. If we just take a peek at this, since basically rates peaked right kind of toward the, middle to end of October, right? TLT in that time is already up 8 percentage points. Already up 8 percentage points just since, was that October 22nd, October 23rd, right around the time that rates peaked. So if we're actually at a time point where rates have peaked and they're just going to keep going down, then TLT should do good. Now, I think there's probably going to be time periods in this in-between where rates are going to likely just kind of plateau, right? And so TLT might not see much movement there, but obviously that's an instrument that will be pretty good in that sort of environment, right? Now, I was on the Twitch live stream here today, okay? And obviously we're covering all the earnings. And then somebody in the chat said that a certain company was reporting, okay? And as soon as I heard this company was reporting, it's stock I own. I sold this stock in the public account, but I still own 60,000 shares of stock in another portfolio. And as soon as I heard this stock was reporting, which I didn't even know they were reporting, I'm like, oh my gosh, like it just ruined my whole vibe. At that moment, I was like, are you freaking kidding me? This company's reporting. It's let me down so much over the last year and a half or so. I was just like, ugh, I don't even want to look at these earnings. Literally, I was like so dreading even looking at these earnings, okay? And I gotta say, I was actually pleasantly surprised. And the stock is honest. It's up 12.5% after hours. Wouldn't be surprised if it's up a lot more than that tomorrow, okay? So here's the situation with honest, okay? And this is a situation for all stocks. And what I illustrated here is actually really important. You guys remember this for all stocks going in the future. And the inverse of this is also true, okay? When a stock goes from horrible story to a bad story, it usually sees a pop in the stock price. When it goes from bad to okay, it sees a pop in the stock price. When the story goes from okay to good, it sees a pop in the stock price. And when it goes from good to great, it sees a pop in the stock price, okay? The inverse of that is also true as well. If a company goes from just a great story to a good story, the stock's going to go down, and probably down significantly. If the story goes from just good to okay, big downward move. If the story goes from okay to bad, big downward move. And if it goes from bad to horrible, big downward move, okay? Now, where's honest at in this life cycle? After this quarter, they just reported they're basically here, okay? They went from horrible to just a bad situation. And so naturally, the stock's going to pop, and I wouldn't be surprised if it continues to see momentum for quite some time. Let's put it that way, okay? Now, I will say Carla, and we're going to go through the numbers here in just a moment, Carla got the ship pointing in the right direction. I'm pleasantly surprised. When she got on this ship, I'll just be honest with you guys, it was a sinking ship, right? It was a sinking ship. It was a Titanic, and she's actually got this ship at least pointing in the right direction at this point in time. When I opened up these earnings, I was like, oh, I don't even freaking want to look at this crap. I don't even want to look at this crap. And I saw these headlines and I said, what? Third quarter revenue exceeds expectations. Transformation initiative drove highest gross margin in 2 years, supporting positive operating cash flow. Raises revenue and adjusted EBITDA outlook for full year 2023. I said, you gotta be flipping my flapjacks. Honest is actually getting this ship pointing in the right direction? No freaking way. You gotta be kidding me, okay? I looked a little deeper. The Honest Company, obviously we know the Honest Company, okay? Carla, what does she say? Our transformation initiative, which we initiated at the beginning of the year, continues to drive strong performance, which, by the way, this is Carla's first year with the company. The 3 pillars of the initiative, brand maximization, margin enhancement, and operating discipline, were evident in third quarter results, said Carla, the CEO. Revenue in the third quarter was an all-time record, and we delivered our highest gross margin in the last 2 years, contributing to another quarter of positive operating cash flow. These results demonstrate the power of Honest brand and the commitment to driving shareholder value. The rigor we're applying across the business reflected in well-executing pricing, cost savings initiatives, and disciplined portfolio management provides us positive momentum as we finish the fiscal year. Most importantly, we look forward to sharing our long-term strategy update with you next spring, which I'll probably report earnings, I would guess, in February at some point, or maybe in March. We'll see. No, in terms of their numbers here, so revenue increased 2% for the company overall. Diapers and wipes revenue was down 5%, but that doesn't tell the truth in the reality. Because in this same quarter last year, they went into Walmart, which you have to comp those numbers year over year. But retail consumption for diaper and wipes was up 32%, which shows that Honest is pretty much the strongest out there in that space right now. Like, they are incredibly strong in the space, okay? Skin and personal care, basically they kind of got out of a lot of the club business, which was basically just killing margins, okay? And so Carla has a view that if we're going to sell products, we need to make good margins and make profits on that. And I applaud that all the way. Like, thank goodness, okay? Because the previous CEO, I mean, you know, I guess he had a view that, you know, just revenue grow to revenue grow. And there was a view of 2020, 2021 when it was a low interest rate environment and you get free money. But let's be honest, the times have changed. You got to make profits, okay? This is profit time. This is margin increasing time, okay? And so Carla has a view that, you know, we're going to sell products that we can actually make money on, which I applaud. Household and wellness revenue increased 68%. So that's a very fast growing segment for the company. They have a lot of new distribution channels for their clothing brand. So 68% growth there is very, very strong. It's obviously a much smaller business for the company, right? It's super small compared to diapers and wipes, and obviously, you know, quite a bit smaller than skin and personal care. So, but that obviously has some very nice growth there. To dig a little deeper, gross margin came in at 31.6%. By the way, they got a long way to go. I want margins going to 35 to 40% type numbers over this next year or two. That was compared to 30.3% in the same quarter last year. Operating expenses decreased $2 million in the third quarter compared to the third quarter of 2022, reflecting higher marketing efficiency. Net loss for the company, $8 million, but that included the $2 million in costs related to the transformation initiative. So, you know, if you take that out, you can say like a $6 million net loss, right? Compared to $12 million net loss in 2022, so huge cut down there. Adjusted EBITDA in the third quarter of 2023 was negative $1 million, including a $2 million in costs related to the transformation initiative. So if you take that out, maybe you're at a plus $1 million for adjusted EBITDA. So steps in the right direction, huge steps in the right direction. As far as the balance sheet goes, cash, $23 million of cash. They also have gotten their inventory down quite substantially, and a company is still sitting on no debt. Net cash provided by operating activities was $9 million for the first 9 months of this year, compared to it's a $60 million improvement compared to the net cash activities at this same time last year, was a $51 million loss there. So huge improvements across the board. Still got a ways to go, still got to bring margins up. Like I said, I think we can go to 35 to 40% margins, so still got a lot of work to do there. But things are headed in the right direction. The ship's at least, you know, in the right direction now. Now, in terms of the updated guidance, here's the numbers. Revenue, low single-digit increase for this quarter that they're in right now, okay, versus Q4 2022. So nice, low single-digit, okay. Adjusted EBITDA, flat to $3 million in the negative, okay, that's progress. As far as full year, for 2023, right, current outlook, mid to single high digit increase in revenue. That's versus previously low single digit to mid single digit. So that's good. So bringing up their revenue guide essentially. And adjusted EBITDA is looking like it's going to be in a much healthier place than they previously thought. Previously, they had adjusted EBITDA of 22 to 26 million in the negative. Now we're at about 15 to 18 in the negative there. So definitely some strides in the right direction. And so, in terms of kind of the new team here, okay, so Carla's now, obviously she's big dog there. She's CEO, and then they got Dave Loretta, and then they got Kate Barton. This is a new squad that's leading this company moving forward. And I went from a place where I probably had zero faith in this company about 9 months ago to very little faith 3 months ago to now I'll say I got slight faith in them. I got slight faith, okay? Now, I'm like at a level 3 of faith, okay? So let's say 10's a max faith, so that would be like me in Metastock, for instance, or Palantir or something like that. So I'm at a 3. So we're still, still relatively low faith in kind of what they got going, but it steps in the right direction. We'll see how it all plays out, but cautiously optimistic. Now, another company that reported, and their stock is plummeting. It's down to $10 after hours, is Topgolf, Callaway Brands, which they own Callaway, they own Topgolf, they own Jack Wolfskin, they own Travis Matthews, and another brand or two. But this stock's plummeting, down 18% after hours. We'll see where it's trading at tomorrow, down to $10. This is a possible buy for me in 2024 at some point in time. I do like the company overall. I do like the brands. I'm not in the biggest rush to necessarily run out and buy it tomorrow or something like that, but it could be a move I make at some point in time. Their earnings were very disappointing. Their guidance was even more disappointing overall, okay? I don't think it's going to be like that forever, but it is the way it is right now, okay? Disney also reported after the bell. Stock's moving up slightly. It's up to about $87 after hours. This is a story of going from horrible to bad. That's the way I'd put it with Disney. It's going from horrible to bad, and so that's why the stock has gone from $70-something to, $87 after hours. They have a lot of progress still to make it there. Bob Iger's still got a lot of work ahead, but I will say, looking at the numbers, kind of hearing him talk on CNBC, I watched that whole interview of him on CNBC today, progress is being made there at Disney. So steps in the right direction as far as that goes, okay? Now, next thing I want to speak about is keep your head into the end of the year, okay? Keep your head into the end of this year, because you're going to hear a lot of conflicting things, a lot of conflicting messaging. Stay focused on you. Stay focused on your portfolio, what you're trying to build out. And because, listen, you're going to hear a lot about Santa Claus Rally. We got about 7 weeks left in this year. You're going to hear a lot about Santa Claus Rally. And that could lead a lot of people to get really excited and FOMO and all those sorts of things, okay? You're going to hear a lot of conflicting messaging around, is the Fed going to keep rates here? Is the Fed going to lower rates in 2024? Recession, all these sorts of things, folks, okay? Stay focused. Stay focused on what you got to focus on, building your portfolio as strong as possible, owning 10, 20 stocks are the best stocks you can possibly own that have the most exciting opportunities. GVD, growth, value, dividends. Stay focused out there, folks. Because like I said, you're going to get a lot of conflicting messaging. Don't get caught up into all the crap, okay? That's all I'll say about that. Don't get caught up into all the crap, okay? Appreciate you guys joining me as always. Thanks so much for being here. If you're looking to apply to join my private group and join the 6- and 7-figure Discord chat, get access to all my course curriculums, everything like that. All of that is a pinned comment down there. You fill out an application. We see if we can get you in there maybe next week or maybe this weekend, something like that. So much love as always. Appreciate y'all and have a great day.